There are a lot of issues that can get the center and the states into some pretty heated arguments, but nothing grinds their gears quite like money. And when I say money, I mean taxes. The taxes we pay go to both the center and the states. While the center gets to raise more taxes, the states end up needing to spend more. To minimize this imbalance, the center is supposed to give a sizable chunk of its earnings to the states. But that's where the trouble lies. Hello and welcome to another episode of The Data Point. Before we get into this issue, first let's understand what the arrangement between the center and the states is supposed to be. As per the accepted recommendations of the 15th Finance Commission, states will get 41% of the net proceeds of the center's shareable taxes. This is a key point, so take a second to jot this down. The 41% is from the center's shareable taxes, not all of the taxes collected. Shareable is the key word here, but we'll get into that in a bit. This devolution of a part of the center's shareable tax revenue to states is mandated by the Constitution. Let's break this down a little more. Let's say in financial year 2019, 100 rupees was collected as taxes. Of this 100, the central government collected about 63 rupees, while the states raised the remaining 37 rupees. This imbalance is due to the center's ability to generate more tax revenue. Income tax, corporate tax, central GST, union excise duties, customs duties can only be collected by the central government. With this framework in place, we can see that the center raises the bulk of the money. The issue comes in when we look at who has to spend more money, the center or the states. Here, the roles are practically switched. States need to finance several economic services like agriculture and transport, social services like education, healthcare, and housing, and that's apart from their administrative expenses. So while the states are raising 37 rupees out of every 100, they end up spending about 62 rupees. The center spends the remaining 38 rupees. What we end up seeing is an imbalance between the center and the states, with the states potentially needing to spend more money than they're raising. So that's why the 15th Finance Commission said that states should get 41% of the total shareable taxes collected by the center. Again, keyword shareable. Out of all the taxes collected by the center, majority is shareable, which means that the center can share that portion with the states. But the other portion, the non-shareable tax, that goes straight into the center's piggy bank. Non-shareable taxes are mostly made up of cesses and surcharges, and the cost of collecting taxes is a small part of that as well. But here's the thing. It's one thing if the non-shareable portion is a fixed percentage, but it's not. The center can decide to increase the amount of cess and surcharge it collects. In fiscal years 2011 and 2012, the non-shareable taxes made up just 10 to 11% of the total tax collected. Then, in FY15, it went up to 13.5%, and then it came back down again to 10% in FY18. But just before and during the pandemic, the center increased the amount of non-shareable taxes to over 15%. A point to note, this does not include the GST cess, which is shareable as compensation with states. So naturally, when the non-shareable taxes take up a larger portion of the total, states end up getting less money, even if the center is still abiding by the Finance Commission's 41% requirement. Now that we know this, let's take a look at what's happened over the past 3 years. The Indian economy was not in the best health in the year before the pandemic, and the situation was only worsened during the outbreak. Consequently, tax revenue was hit, with the center collecting less tax than before, even when we look at it in real terms. Here's where things get interesting. While the tax collected by the center declined, its share in the collections grew. On the other hand, the state's share in the center's taxes saw a fall. In the past 3 years, the gap between the center and the state's share in the divisible portion of the tax has widened significantly. Weird, right? If the center's tax collection declines, both the state and the center's share should decline. How did the center escape this fall? This is where cesses and surcharges come in. As we saw before, the amount collected as cesses and surcharges are not a part of the shareable pool. And so by increasing these types of taxes during and just before the pandemic years, the center was able to increase its share even when the amount collected was falling, thereby forcing the states to bear the burden of the revenue loss. Clearly, the safety measures put in place by the 15th Finance Commission don't do much if the divisible pool of tax revenue continues to shrink. But the story doesn't stop here. The revenue that the center collects as tax can be used however it wants, but the revenue it collects as cesses and surcharges can only be used for specific purposes. But that's not exactly what's happening. According to the Comptroller and Auditor General's audit of cesses, there are several instances where money collected as part of a particular cess does not make it to its intended destination. For example, in fiscal year 2019, nearly 9,000 crore were collected as social welfare surcharge on customs, but no dedicated fund was created to make sure that money was being spent for that purpose. That same year, cesses worth 1.1 lakh crore rupees, or 40% of the total cesses, were not transferred to the reserve funds and were retained by the CFI, the Consolidated Fund of India. So in other words, the center kept it for itself. In fiscal year 2020, the audit found that over the past 10 years, nearly 1.28 lakh crore rupees was collected through the cess on crude oil, but no funds were transferred to the Oil Industry Development Board. These funds also remained with the CFI, aka the center. The audit found that in FY20, about 40% of the cesses valued at 78,376 crore were not transferred to the reserve funds where they were meant to go. And that's the story. Still confused? Imagine it's your birthday and you've bought a 1 kg birthday cake. That's how much the center raises as tax from us. Cut a small slice from that as cess and give it to your neighbor, and announce to the party that 41% of the rest of the cake is shareable with your friends, and the remaining 59% goes to you and your relatives. All fair and square, everyone's happy. Now the pandemic hits and your income dips. You couldn't afford a bigger cake. You got a half-kilo cake. However, you cut a bigger piece as cess and announce to the party the same as before. The shareable part is much smaller now due to the bigger cess and less revenue. Your friends, the states, protest because they came to the party hungrier this time around. Here comes the kicker. Remember that bigger piece that you cut for your neighbor as cess? You keep a big part of that and you just give him a small part. Clearly, the center wants to have its cake and eat it too.